All right, today we're going to break down what happened with Oxford Industries' second quarter. And it's a really fascinating story. A classic case where the headline numbers just did not tell the whole story, and it led to this absolutely massive pop in the stock.
So let's just dive right into the central mystery here. How on earth does a company miss its revenue number but still see its stock shoot up over 20%? That's the big question we're unpacking, because clearly the market looked right past that top line number and saw something way more important underneath.
And we're not talking about a little bump. A 20% rally in one day is a huge vote of confidence from investors, especially when you remember the stock was down almost 50% for the year leading into this report. So this signaled a really dramatic shift in how people were feeling about the company.
So this is the puzzle that kind of confused everyone at first glance. On one side, you had an earnings beat. Adjusted EPS came in at $1.26, which was nicely ahead of the $1.18 consensus. But on the other side, revenue of $403 million, it just missed the $406 million Wall Street was looking for. So with a mixed report like this, the market had to figure out, and fast, which number actually mattered more.
Okay, so to really understand how investors were able to just shrug off that revenue miss, we've got to dig a little deeper. We need to break down how the company's individual brands actually performed.
Yeah, to get the real picture of the quarter, you have to look under the hood at Oxford's brand portfolio, because it's not just one single business. It's really a story of different strengths and weaknesses, and they all played a part in the final numbers.
And this brand mix right here gives you some really important context. You can see Tommy Bahama is the giant, right? It's over half the business. So however Tommy Bahama goes, that's pretty much how the company goes. But Lilly Pulitzer, that's strong number two, had a quarter that turned out to be absolutely critical. And yeah, Lilly Pulitzer was the real bright spot here. The brand actually posted positive direct-to-consumer comps, which in this retail environment is a fantastic result. And management was super clear that successful product innovation was the main reason why. And this isn't just some vague corporate jargon. It's real, tangible proof. I mean, when the CEO gets on the call and points to a specific product, the linen sea spray jacket, and says it's sold out completely, that tells you the brand has some serious momentum and knows exactly what its customers want. But then you have the flip side. The portfolio's heavyweight, Tommy Bahama, kind of stumbled. And management was really upfront about the problems. They basically said, look, we missed the mark on our color choices for spring and summer, and it really hurt us in a key market like Florida. Now, that's an operational mistake for sure, but it's also something they can fix. Okay, so moving past the individual brand performance, the single biggest dark cloud hanging over Oxford and really the whole apparel industry has been the impact of U.S. tariffs. This was the issue that could make or break the stock for investors. Management actually put a number on the potential annual damage, and it was a jaw-dropper. Around $80 million. For a company of Oxford's size, that is a massive threat to their profitability. The market's biggest fear was that this cost would just completely crush their margins. But, and this is key, management came to the call with a clear, credible plan. They weren't just going to sit there and take the hit. They were fighting back. First, by moving their sourcing out of those tariff-heavy regions. Second, by buying inventory early to get ahead of new taxes. And third, by strategically raising prices on certain items. The important thing here was that this wasn't just some vague promise. It was a concrete playbook to wipe out nearly half of that potential $80 million problem. And this was the moment that turned everything around. Despite the revenue miss, despite the insane tariff pressure, management did something that totally shocked the market. In the best way possible, they held their full-year guidance steady. I mean, just look at these numbers. Reaffirming both the sales and, more importantly, the adjusted EPS forecast for the entire year was this huge signal of confidence. It basically told investors, yeah, we've got this. Our tariff plan is working and we can manage through the weakness at Tommy Bahama. This is what lit the fuse for that 20% rally. And they didn't just ask investors to trust them either. They gave out real-time data to back it up. They said that so far in Q3, trends were already getting better. Total comps were positive, and crucially, Tommy Bahama's performance had stabilized to about flat, which is a huge improvement from Q2. This gave their guidance some serious credibility. So, the huge relief rally is in the books. Now what? What are we looking for in the next earnings call? Let's put on our analyst hats and try to game out what the near-term future looks like for the stock.
Okay, so for Q3, we expect Oxford to deliver right within their guided range for a loss per share, which is pretty normal for them seasonally. After that massive run up, we think the stock is probably going to trade sideways for a bit, kind of consolidate, as investors wait to see how the all-important holiday season shapes up. So for right now, we're rating the stock market perform. The worst fears are off the table, but the full turnaround isn't quite proven yet. All right, now for our outrageous but plausible trade idea. Here's the pitch. The bar is still set pretty low for this company. So, if Tommy Bahama really nails its product reset for the holiday season, and if management's tariff plan actually saves them even more money than they guided to, well, then this stock could quickly go from being a relief story to a genuine turnaround play. The potential upside from here could be really significant if those two things break the right way.
And as always, just a final reminder, this is not financial advice.